right, so it's 6:30. It's Wednesday, April 16th, and it's time for our special webinar. Sarah Brenner from the Ed Slott Elite Advisor Group is joining us tonight. I see people filing in. Sarah, I don't know, can you see the number of people or anything there?
I see the numbers going up. Yep.
Good, good. Yeah, good. I didn't do a poll, but I do have a survey at the end of this, so I'll share with you what folks say afterwards. But as people are coming on, I just want to remind everybody that this webinar is being recorded. There is a question and answer button on the bottom of your screen, so you can click in and type questions as we go, and I'll stop periodically and we'll address the questions. We'll go for about a half an hour to 45 minutes, depending on the number of questions. And if you have follow-up questions, when you log off of the Zoom meeting tonight, you'll open up into my calendar and you'll have an opportunity to schedule some time to talk with me to address those questions. So just kind of a raise of hands. Don't push the raise hand button, but raise your hand if you can see us and hear us okay for me. All right, great. Good, good, good. All right, so I first want to thank everybody for being here for this special webinar. I think this is about the 100th webinar we've had this month, I feel like. But so we have Sarah Brenner, who's an attorney, joining us tonight, as I said, and she's the Director of Retirement Education for the Ed Slott Group. And before we officially say hello to Sarah, let me read her impressive resume. And by the way, she's close by here, so she lives in the Lehigh Valley, outside of Philadelphia, close by. But Sarah has worked for almost 20 years helping clients solve complex technical IRA questions. She has been a contributing writer for many IRA text, articles, and training manuals, and has been quoted in national financial and tax publications such as CCH IRA Guide. She's an experienced speaker who has educated thousands of professionals in the financial industry, including attorneys, CPAs, bankers, financial advisors, and brokers on retirement plan rules. Sarah has won praise for her ability to communicate complex laws in an easy to understand way and provide practical strategies for clients. Sarah is a contributing writer and editor for Ed Slott's IRA Advisor newsletter, distributed to thousands of financial advisors nationwide, and writes for several areas of the company's website. That's www.irahelp.com. Sarah also serves as a valuable resource for the members of Ed Slott's Elite Advisor Group, a 400+ member organization of some of the country's top financial advisors who are dedicated to becoming experts in IRA distribution planning. She consults with firms' clients and creates IRA course manuals and training programs for financial advisors. Sarah is a graduate of Smith College and Villanova School of Law. Everybody around here loves Villanova. She's a member of the Pennsylvania Bar. She practiced law with a concentration in elder law for several years, and for 15 years was a senior consultant with PMC Pension Management Company, an independent IRA consulting firm for financial organizations nationwide. So help me welcome Sarah. Hi, Sarah.
Hi, Mark. Great to be here.
Oh, it's great to have you. And everybody, I've talked about this before. There's a lot of great folks who work at the Ed Slott Group, but Sarah is my go-to person whenever I have a question. And sometimes she gets a lot of questions from me over and over again. And sometimes we're quiet for a while, but I appreciate you always being there, Sarah.
It's always a pleasure.
Thank you. All right. So tonight we're going to talk about using a trust as a beneficiary for an IRA. And it's a complex topic that has gotten more complex. And we already have a question. Let me just speak. So Don said, "Go Cats." So that's in response to the Villanova. Thanks, Don. Good to see you. So Sarah, let's start with why is it important, first of all, to even name a beneficiary of an IRA? Can you talk about that a little bit?
Yeah, sure. A lot of people don't realize that IRA money passes via the beneficiary form. IRAs don't pass through wills. They don't go through probate unless you name your estate as your IRA beneficiary. So IRAs pass outside of probate. So what you say in your will, that's not going to help you direct where you want your IRA funds to go. That's why the beneficiary form is so important. And all the time. Mark knows this. We see situations where people, for a whole variety of reasons, don't complete the beneficiary form, or they don't keep the form updated. And that can create all sorts of problems, because if you don't pick a beneficiary, the IRA document is going to pick one for you. And it may not be who you want. Many IRA documents, the default beneficiary is the estate. And that is not a good outcome. You don't want your IRA funds to go to your estate. Then the IRA has to go through probate. It can be expensive. It can be time consuming. And having your estate as your beneficiary can negatively affect your options when it comes to taking distributions, if you're a beneficiary.
Yeah, great answer. Let me ask you this, because I get asked all the time, and I've just lost my train of thought, so I'll come back to it. But it is vitally important, of course, to name a beneficiary. But it happens all the time, doesn't it? Where folks just miss it, or they don't update it. People that listen to my webinars all the time, and certainly clients of mine, know that we always talk about updating the beneficiaries once a year, or reviewing it once a year. And that's something I learned from Ed. So I used to have the idea of, well, listen, I set a beneficiary designation for this client 5 years ago when we set up the account. Why should I have to go back to review it? So tell me, with some of your experiences, why is that important? Why is it important to review it every year? Why do we now keep it on a checklist to make sure that it's included and we look at it every year? But tell everybody why you think it's so important.
Yeah, I can tell you all kinds of horror stories. People's lives change. You might have a situation where someone gets divorced, and they had their spouse as their IRA beneficiary. After the divorce, it's very likely they don't want their spouse to be their beneficiary anymore. Guess what? If they don't update their IRA beneficiary form, if something happens to them, their spouse could end up with everything. So that's just one example of the dangers of not updating a beneficiary form.
Yeah, and I told you about the classes that we do around the area, and I tell this story often. There was a fellow who came to us who was a very organized individual after one of the classes and said, I checked my beneficiary designations, like you said, and he's a teacher, and his retirement plan is with PESERS, the Pennsylvania State Employee Retirement System, which is a huge organization. And he learned that all his beneficiary designations had been wiped out. So they had a change in computer program,
Mm-hmm.
and about a large percentage, I think it was about a third, or maybe even 10%, a big number of people lost their beneficiary designations and they didn't know about it. So if he didn't check this, he wouldn't have a beneficiary designation. So I remember my question now.
It's a great point, Mark.
Right.
You can't rely on the custodian to do this for you. That this is something that people and their advisors need to be proactive about.
And you can. And even though I believe we are on top of it because we review it every year. We work with Charles Schwab as a custodian. We have money at different annuity companies. There's money all over, Vanguard, Fidelity, wherever the money is. These are computer systems.
Yeah.
And they're not perfect. Right?
That's right.
And yet, even worse yet are the people sometimes handling those systems. So we are surprised sometimes when we do that review and say, well, wait a minute, this isn't what it's supposed to be. And clients also sometimes look at the flow chart that we do and at their beneficiary designations, the way things go, and they'll say, you know what, I gave so-and-so X number of dollars for a house or a car or something, and now I want to change this. So it gives everybody a chance to review it. The question I was going to ask you, and that I had forgotten, I wrote it down this time. If somebody names a beneficiary and somebody else is listed in the will, so my entire estate is in IRAs, let's just say, make it simple, and I name Jack down the street as my beneficiary, but my son is listed in the will, who's going to win? that fight.
And that would be Jack and not your son. Whoever is listed on the beneficiary form is going to be the one who gets the IRA money. And that's true, even if the main beneficiary under your will is someone else. So that's another reason why the beneficiary form is so important. Sometimes people think, oh, I'm taking care of everything if I have a will, but that's just not the case.
That's right. And I specifically didn't say it's spouses because I know spouses are different, right? But
Right.
But yeah, I just wanted to strike that home for everybody because they get caught up in that. And I tell a personal story in my classes about that happened to my sister when she passed away. She had named my mother as beneficiary of her 403B when she started the job she had at 16 years old. And even though she knew she had a terminal illness and had taken care of everything with her attorney, never changed that beneficiary designation. And it became a bit of an issue, as you can imagine.
Yeah, it's very common. People name a beneficiary and they think that they're done. And really, it's an ongoing process. It's not once and done. It's something that needs to be revisited as life circumstances change. People get married, they get divorced, they have kids, all sorts of things happen. So you need to, have some sort of system in place where you're reviewing the beneficiary forms on a regular basis.
That's right.
And, Ed always says this stuff sounds easy, but this is where big mistakes get made. And we have a whole series of court cases that we talk about in our workshops, real people who end up in situations where the wrong person gets the IRA funds. And sometimes, we're talking a lot of money just because the beneficiary form wasn't updated.
Yeah, they're my favorite parts. The tax law update, the court case updates. I love that. So what Sarah's talking about, and many of you know, is that twice a year, Ed and his group, Sarah being one of them, run these workshops, and we're required to attend. I guess after a period of time, you're only required to attend one per year, but you're strongly encouraged, I'll say, to attend both.
We believe in education.
I know you do. But the manuals are very thick. There's a lot of material, but and there's a lot of things I like, but my favorite part are the case law updates because I just like that stuff. So
it's great because you can't make this stuff up. The things that happen out there, it's unbelievable, and these are real people. These are not hypotheticals that we're coming up with.
That's right. Yeah, that's my favorite, and that's followed by Shannon Evans. Shannon's my other favorite. She's great. All right, so we know why naming a beneficiary to an IRA is so important, but why would you name a trust as a beneficiary to your IRA? Why would you even consider that?
Well, naming a trust makes things more complicated, and trusts are expensive. So you need to have a good reason to name a trust as a beneficiary. Whenever I hear of anyone who's thinking of going down that road, naming a trust as a beneficiary, I think one question they really need to ask is why? And you got to have a good reason. And my attorney told me to do it is not a good enough reason. Have the attorney explain why the trust is necessary in a particular situation. Now, there are some really good reasons to name a trust. Ed likes to say you name a trust when you don't trust. So you name a trust when you think, you need some extra protection as to where the money's going to go. And sometimes, again, there's good reason for this. There's good reason to have control from the grave. You might have a situation where you have a minor, a child. You don't want to name a child outright directly on the beneficiary form. That's just not going to work. A child, legally can't sign off on accounts. They can't conduct business. So that's not a good idea. A trust is a good way to take care of a minor. Special needs beneficiaries, special needs trusts. If you have a special needs beneficiary, that's a good reason to name a trust as your IRA beneficiary. If you're concerned about creditor protection, that can be another reason to name a trust as a beneficiary. Anytime you have a vulnerable person, maybe somebody who's not sophisticated with money, that can be the type of situation where a trust might be necessary. One thing I will tell you, a lot of people think, oh, if I name a trust as a beneficiary, I'll save on taxes. That is not the case. You're not going to get any kind of income tax break by naming a trust as a beneficiary. In fact, quite the opposite, because trusts get hit with very high tax rates. So if you name a trust as a beneficiary, you're really not saving on taxes. So that's something to keep in mind.
So I wrote down a couple of notes while we were talking. So you mentioned creditor protection, and then let me just write one more. And that was a really good point, because we all know that IRAs enjoy quite a bit of creditor protection, right? So we went over this in a few webinars, but I don't know what the limit is now on a contributory IRA. I think it's around 1.3 million, right? Is the creditor protection? Is that about right?
Yeah. If it's your IRA, IRAs do get a lot of protection in bankruptcy under
That's
federal law, up to very large amounts. I think any type of IRA funds would be protected in bankruptcy under federal law. Other creditors outside of bankruptcy, it's a little bit trickier. Their protection comes from state law, but a lot of states do have some protection from other creditors for IRAs. But when we get into inherited IRAs,
Yeah, that was my point.
there is not nearly as much protection there. And that's why a trust can be helpful, because a trust can give you that creditor protection that inherited IRAs just don't enjoy.
That's right.
We had a Supreme Court case a couple years ago. We live in a country that's pretty divided, but one thing that the Supreme Court was united on was the concept that inherited IRAs are not protected in bankruptcy. So if you want to get that protection, a trust can help there.
Yeah, that's a great point. So just to clarify what I said, so contributory IRAs are different than rollover IRAs. So rollover IRAs can enjoy the complete amount of creditor protection for bankruptcy. Contributory IRAs are a little bit different.
Yeah, that's where it's capped. But if you look at that cap, it's so high that even if you would have contributed every year, you still wouldn't be reaching it, even if you had great investments with all kinds of earnings. So yeah, there's a lot of protection there.
Unless you invested in PayPal.
Yeah, maybe.
That's right.
That might be the
and that is not a recommendation to invest in PayPal. All right, so creditor protection is one. How about, I don't know if you mentioned this, but spendthrift. What if I had my son who I wanted him to inherit the money, but I wanted him to inherit it, and he's not a minor, and I'm not picking on him if he can hear me, but just as an example, would that work? Does that make sense? If I just want him to receive, X number of dollars a year, is that something would that be a reason to name a trust as a beneficiary?
Yeah. A lot of times, we'll see situations where an IRA owner has adult children, and they're concerned because their adult children are still fairly young, and maybe, not the best at managing money. So that can be a situation where a trust can be helpful, because you can limit then the access to the IRA money. You can keep it in the trust instead of paying it out, which limits the amount of money that could go to the beneficiary, who might, waste it all. And that can be, really, really important in some situations. Maybe you have a beneficiary with a drug problem or an alcohol problem. That would be the type of situation where a trust could be helpful. Now, keep in mind, there is a trade-off. You're getting the control over the funds, and you're preventing the funds from going out to this beneficiary who might, blow the money on, drugs, alcohol, whatever. But when the funds stay in the trust, What you're getting hit with a traditional IRA would be those high trust tax rates. So you got to weigh what's more important. Do you want the control? And if so, you got to be willing to pay the higher tax rates.
So if you want to reference what Sarah's talking about, on our webpage, attleborowealth.com, we talk about this all the time. I have a section on there, Sarah, that's the slot corner. And in there is, a couple of the videos about, what is the Elite Advisor Group, and there's information about Ed. And I have the charts, the orange, the green, the blue charts in that corner to make sure we give credit to Ed, you folks for creating them. But on the orange chart, which is the, tax planning table, you'll see individual tax rates, and it's that long chart for married and filing joint.
Right.
And then you'll see the trust tax rates. And it's a much shorter chart because the higher tax rates get the higher tax rates get triggered on very relatively little income. And that's what Sarah's talking about. So you can reference that. You go to attleborowealth.com, go to the slot corner. That's
right here.
right there. That's right. We all use it.
On my
have
desk,
mine up most of the time. Yep. So I encourage you to download that. You can use it. And that's what Sarah's referencing. So that's good.
You'll see that with a trust, you reach the highest tax rate with only $13,450 in income.
Yeah.
So, not very high at all. And all of a sudden you're at the highest tax rates. With individuals, it's much, much higher before the highest tax rates kick in.
Yeah, let me just take a second to direct people, because I no matter how many times we talk about this, somebody says, I can't find that thing that you were talking about. So let me just take a second. I want to share my screen and show you. And I lost where the heck is it? Okay, there it is. So you should see our web homepage. So raise your hand if you can see the Attleboro Wealth Management homepage for me. Thank you. So this is what I'm talking about, the slot corner. So this is, this is me and Ed. We've got some information here. We've got some videos, but down, if you keep scrolling down, this is what Sarah just held up. So this is the tax planning chart. You can just reference it here on the page, or you can click here and download it. I keep it here to give Ed and his team credit, but this is what we're talking about. This big, if we go from 10% to 37.5% or 37%, excuse me, in the tax code, or what your marginal tax rate is. But down here with trust tax rates, we go from 10 to 37, and it's really tiny. There's only four brackets there. And as Sarah said, anything over $13,450 that the trust generates. So now you take your $1 million, have an IRA, the trust is beneficiary of your IRA, and it generates $13,000 in income and dividends or distributions or what have you. That's taxed at a much higher rate. We don't hit the 37% bracket for individuals married filing jointly till $647,000, or single filers $539,000. So, there are definitely some things to consider there. Does that make sense, everybody? I hope. Yeah.
Yeah, and I just like to bring up there is a way. There is a way to avoid these high trust tax rates. That if you're thinking about naming your trust as your IRA beneficiary, you may want to think about, and that would be doing a Roth conversion, because with Roth, distributions to beneficiaries, including distributions to trusts, are going to be tax-free. So you bypass all these issues with the high trust tax rates. So if you have a situation, you want to name a trust as a beneficiary, maybe it's to protect a child with a drug or alcohol problem. So you know that some money's going to have to stay in the trust, not going to be paid right out to the beneficiary. It's going to stay in the trust, going to be hit with those high trust tax rates. Great way to avoid that. Convert your traditional IRA to a Roth IRA. And name the trust as the beneficiary of the Roth IRA instead. And then you don't have to worry about any of the stuff with the high trust tax rates.
You're right. And my favorite thing, the Roth IRA. That's right. Sarah, before we move on, let's talk a little bit about taxation and just so everybody understands how it works. So if I name a trust as my beneficiary and I pass away, when is that money taxed? Is it when it transfers to the beneficiary, or when it's distributed, or is it both? How does that work?
It's a great question. It's important to understand, if you name a trust as the beneficiary of an IRA, upon your death, what's going to happen is an inherited IRA is going to be created. So it'll be titled in a special way. It'll be the trust as beneficiary of you. That's what the titling would look like on that inherited IRA. And at that point, there is no taxation. Everything is still in the IRA. Nothing's left the IRA. Then what happens is money is distributed to the trust. And at that point, one of two things can happen. It can stay in the trust, or it could be paid out to the beneficiary. Once the money leaves the inherited IRA, it's going to be taxable. The question is going to be then, is it going to be taxed to the trust, or is it going to be taxed to the beneficiary of the trust? If it stays in the trust, then the trust will owe taxes at high trust tax rates. If it's passed out to the beneficiary, then the beneficiary will pay taxes on the distribution at their tax rates. But think about it. One of the main reasons why people have a trust is because they don't trust. So you want to keep the money, in the trust. You don't want to pay it all out. So there's a good possibility with a lot of trust that some money is going to stay in the trust. And that's when those high trust tax rates would kick in.
All right. So now we're going to jump into the Secure Act, because my next question is, well, what about RMDs? Are there required minimum distributions when someone names a trust as a beneficiary, and how does that work? So are you ready to talk about RMDs and the Secure Act and trusts and everything that goes along with that?
Oh boy, yeah. The Secure Act really makes a mess out of things when it comes to trusts and IRAs. It really messes a lot of things up. A lot of people name their trust as their IRA beneficiary because they're thinking long term. And that used to work great because we used to have the stretch IRA, where distributions from an inherited IRA could be stretched out over a very long period of time. So that worked out really well for trusts. The Secure Act changed that. The Secure Act now is requiring for most beneficiaries, not all, but for most, that the inherited IRA be emptied within 10 years. So the money's going to have to be paid out to the trust within 10 years. So that really changes things. And just the other week, I was talking to Mark about this. We got Secure Act regulations from the IRS, where the IRS gave us their interpretation of the Secure Act. And one of the things that the IRS is saying is that if an IRA owner dies after required minimum distributions have started, then during that 10-year period that we just talked about, annual RMDs are going to have to come out to the trust. So boy, that just adds a whole other level of complexity here with the Secure Act and trusts. So you got to be really sure that the trust is the way to go, because you are taking on a lot right now.
Yeah, and so what's a way to avoid those RMDs if you're naming beneficiary of the trust? I'm going to give you a softball here.
You want to go with the Roth IRA. If you convert that traditional IRA to a Roth IRA and name your trust as the beneficiary of the Roth IRA, you avoid this whole mess. You still have the 10-year rule that's going to apply, but you're never going to have annual RMDs to worry about. If you have a Roth IRA, that rule only applies to traditional IRAs. So that's another way that the Roth IRA is the big winner. You could keep that inherited Roth IRA intact for 10 years, let those earnings grow tax-free, and then pay out to the trust if you wanted. You would have that option.
Yeah. And you can't discount the other option. And Ed talks about this a lot and taught me more than anybody else has about the value of life insurance. And we can solve a lot of these problems by using life insurance, because you can you're naming beneficiaries. You can also name trusts. You can do whatnot, but there's a lot more tax advantaged situations with life insurance than certainly with a traditional IRA. Do you agree, Sarah?
Yes, yes, yes. Life insurance is a great way to fund a trust. You avoid all these complicated IRA rules. You don't have to worry about RMDs. You don't have to worry about taxes. There's a whole bunch of stuff that
Yeah.
you don't have to worry about if you fund your trust with life insurance instead of with your IRA. That's a great way to go. In fact, we often recommend doing some distribution planning, taking money from your IRA strategically and purchasing life insurance.
Yeah. Yeah, that works a lot. One of the biggest problems that we run across with getting Roth conversions done for clients is getting them done fast enough. We all know the taxes have to increase dramatically, if not double in the next 10 years. And we're working in the short window of the Tax Cuts and Jobs Act ending in the end of 2025, and all these pressures coming from Social Security, Medicare, and everything else now. But one of the, other than what we've experienced so far this year, we've been chasing these fantastic returns in IRAs, and you have a good plan to do with these Roth conversions, and you get these great returns, and it just sets you back a little bit. So sometimes taking distributions helps with that as well, and and funding life insurance, like Sarah said, and then you get all these added benefits of life insurance as well. But all right, now, so we definitely want to focus on Roths if they make sense for you. Of course, that helps with trust as beneficiary. What other updates? And then we're going to go into there's some questions that were emailed in before, and then I have 6 questions pending. So what other updates from about the Secure Act would you like to discuss, Sarah?
Well, I think we've talked about the fact that the Secure Act regulations make the rules for trusts as beneficiaries more complicated. They were already complicated. This makes them more complicated. So I think it's just another reason to stop and think and really give serious thought as to whether a trust is the way to go. It's another reason to reconsider if you're thinking about naming a trust as a beneficiary. You really need to be sure that you have a good reason. We talked about some good reasons. You need to make sure that you have one of those.
Okay, good. All right, let's go to some questions. So the first one's from Kathy. Hello, Kathy.
Hey, Kathy.
So this is a 3-parter. We talked about this a little bit before, Sarah. So when a person designates his or her beneficiaries, what occurs or is required if they're minors when the distribution is made per that beneficiary designation? So I am paraphrasing a little bit, Kathy, but I think I have the crux of that. So what happens when you name a designated beneficiary and that person is a minor?
Yeah, I wouldn't encourage naming a minor directly on the beneficiary form. Minors, can't sign off on things. They can't manage their own business. So that doesn't work too well, because you would need to have a guardian be able to act for the minor. And sometimes that process can get complicated. It's better to name a trust. A trust for a minor can be a good idea, especially if a large IRA. Sometimes people will use an UTMA or an UGMA account and name the UTMA or UGMA account as the beneficiary of the IRA. That can work too, especially if it's a smaller IRA. You don't want to go through the time and expense of setting up a trust. That's another simpler alternative, and it's better than naming the minor outright on the beneficiary form.
That's interesting. I hadn't thought about that. So what are the tax ramifications on the uniform? The UGMA is a Uniform Gift to Minors Act. That's
Right, right.
the accounts that people sometimes open when they want to help kids fund college if they're not using a 529, or for a future home. There's some more flexibility than an education based 529 plan. But what's the tax comp or
Well,
uh,
the benefit
what
of
happens there?
naming it
Is
is
there
you don't have
taxation?
to set it up at the time that you name it as the IRA beneficiary. It can be set up later. And you can pick whoever you want to be
Sure.
the custodian of the account. It doesn't have to be the parents of the child. So that, that can be a good thing if there's, some issues, if you're not sure that the parents are responsible. The big issue with this is that some custodians won't let you do it.
Yes.
So it's perfectly legal, but custodians get to make their own policies, and some of them just won't allow it. But it's worth asking if you have a smaller IRA and you don't want to go the trust route. It's an alternative that you can explore.
Yeah. All right. The next part of this question, and Sarah had an interesting take on this, but the question is, does a per stirpes, per capita, or a direct beneficiary designation have different requirements if the receiver is a minor? So tied into the first question, but it addresses the per stirpes and per capita designation on the beneficiary designation form.
Yeah, I was telling you, Mark, I'm not a big fan of per stirpes or per capita because per stirpes and per capita can mean different things in different states. There's not one definition for these terms. It varies. And some documents, I've seen documents that have their own definition of per stirpes and per capita. And what this does, it interjects a little bit of confusion sometimes into the beneficiary designation form. And we don't want that. We want our beneficiary designation forms to be as clear as possible. I think it's best to name primary beneficiaries and contingent beneficiaries, super clear who's getting the money, what percentages, make sure that the percentages add up to 100. We've seen people make that mistake. 1/3, 1/3, 1/3 does not equal 100. If you go third, it doesn't work out. So you need to make sure that the math is right. Make sure the beneficiary designation form is clear. So I would recommend avoiding per stirpes and per capita, and just be sure that the form is updated regularly.
Then if there's a minor who ends up being a contingent or a tertiary beneficiary, then that's when the decision comes in. Doesn't make sense to do that in a trust.
Right. Right.
But
If
like
you have
you
a larger
said,
IRA, that might be a time for a trust.
yeah, and like you said, that might be really complex thinking and planning for something that's easily addressed when the time comes that somebody passes, right? So God
Right.
forbid your primary or contingent beneficiary passes away. You likely have time to address that. It does happen when people pass, at the same time, but boy, as you get older, that's highly unlikely, right? Or less likely. And you usually have time to address it. It's not what you want to do right away, but I have to tell you, that's where we step in, right? Because when we're notified, people always contact us and say, my husband, my wife, somebody in my family passed away. We usually learn pretty quickly. And, we grieve with you often, but we also, our planning wheels start kicking in, right? This is what we need to do. When we learn that somebody's in a nursing home, and we've been through this just too many times, even though we check our beneficiary designations every single year, the first thing we do is check beneficiary designations when we hear that somebody is heading down that path. So that's certainly when we'll kick in. So my point being is that I think sometimes you can overanalyze things and try to do everything that's perfect, right? And I guarantee you that's going to change very quickly. And that's a good thing, because these things aren't set in stone. We can change them. Make sense?
Yeah, it's a lot easier than changing a will, for
Oh
example.
my goodness, yeah.
A beneficiary form, it's free to change your mind on that. If you're going to have your will redrafted, I'm betting it's going to cost you something, and it's going to be a much more complicated process.
That's true. All right. We talked about this a little bit. Is there any difference if the funds are coming from an insurance policy or from an investment or a bank account? So this is talking about it going to minors as beneficiaries.
We talked a little bit about using life insurance. Life insurance is a great asset to fund a trust for a minor, and you avoid all the complicated IRA rules and taxation rules that we talked about. So that's a great way to get money to a minor, is to fund a trust with life insurance.
Yeah, great. Okay, let's go through some of the other questions here. Roseanne asked, I think we answered this, but do IRAs pass on to beneficiaries tax-free? You can take this, Sarah. So
if it's a Roth IRA, right?
Yeah. What's that?
Yeah, if it's a Roth IRA, most Roth IRAs will be distributed to beneficiaries tax-free. Unfortunately, that's not the way traditional IRAs work. Those distributions are almost always going to be fully taxable. So they'll be included in taxable income. It's ordinary income.
Yeah, just like you earned it at a job.
Right.
And it gets very complicated, as we've been talking about, with the new regulations from the Secure Act, because if the person you're inheriting the IRA from has already had to start taking their required minimum distributions, then you also have to continue those required minimum distributions. And then the account has to be completely depleted by the end of the 10th year. If that person has not, and Sarah's going to correct me if I have this wrong, but I think I've got it right. If the person has not yet begun their required minimum distributions, then no distributions are required during that 9-year period, but the traditional IRA still has to be depleted by the end of the 10 years. Is that right?
Yeah, that's right, Mark. The Secure Act really does beneficiaries no favors, and the Secure Act regulations don't help the matter. We went from pre-Secure Act, where there was a stretch where you could really minimize the tax hit, to the Secure Act, where you're looking at a 10-year period. And now they're saying if the IRA owner died, just as you said, after their required beginning date, once they were taking RMDs, a certain set amount, an annual RMD is going to have to be calculated every year. And it's going to have to come out each year. Coming from a traditional IRA, it's going to be taxable. So that there's a lot to think about there.
Yep, and we have that I don't know tax rate, and the I don't know tax rate is any tax rate beyond this year, right? So
that's right. We don't know where tax rates are going to go. And I know Ed says this all the time. Eventually, we're going to have to pay for everything, and rates are going to have to go up.
Yeah. Roseanne asked about minors as beneficiary. I think we covered that quite well. Answered that one from Walter. All right, so Walter asked, so in the case of an inherited IRA in a trust and the 10-year rule, does that mean it must be distributed to the beneficiary, or if not, the non-distributed portion is again subject to trust taxes when distributed? For a Roth IRA he's referring to. He cleared that up. Does that make sense?
Yeah. If we're talking about a Roth IRA, when the distributions go into the trust, there are no taxes. So the distributions would leave the inherited Roth, they go into the trust, no tax consequences. That's what makes the Roth so great. Distributions from the inherited Roth to the trust are going to be tax-free. So you avoid those high trust tax rates.
And then they have to be distributed by the end of the 10th year also, whether it's a trust or a named person.
Yeah. The inherited IRA has to be depleted within 10 years for most beneficiaries. There are some exceptions, but most beneficiaries are going to get 10 years. At that point, all the money has to be out of the inherited IRA. It could still be held in the trust. Then that would be okay. The trust could continue for years and years and years. That works. And if it's a Roth, there wouldn't be any tax consequences to holding those distributions from the inherited IRA in the trust. They would not be taxable when they go into the trust.
But then after that 10th year, they would be taxable, right? Because the Roth would really cease to exist after that distribution into the trust. Am I understanding that?
Yeah, there's no more Roth IRA, but you've paid everything out tax-free. So then
Right.
it's in the trust. Everything gets to go into the trust tax-free. Now, at that point, you're outside the Roth. So if the money's kept in the trust and, there might be earnings after that, then normal, regular tax rules would kick in.
So if we're just expanding on Walter's question a little bit and now erasing the Roth portion. And folks, if you also go to that webpage I showed you, there is a gold chart that talks all about the Secure Act. So when Sarah and I are talking about, well, some beneficiaries, some not beneficiaries it applies to, they're called eligible designated beneficiaries. So there's a great breakdown that the SLOT group did on what are non-eligible designated beneficiaries, who are eligible designated beneficiaries, and some of the different rules. So with Walter's case, he was talking about a Roth IRA, but let's talk about a traditional IRA. So in the case of a traditional inherited IRA in a trust and the 10-year roll, does that mean it must be distributed to the beneficiary? Or if not, the non-distributed portion is again subject to tax trust rates when distributed. So let's just focus on the first part of that, Sarah. So you name a trust as a beneficiary to a traditional IRA.
Right.
Now the inherited IRA is in the trust. And let's just say we must have RMDs, right? It's the person.
Right. What you're going to have is you're going to have an inherited IRA titled in the name of the trust. And then what will have to happen, as with all inherited IRAs, distributions are going to have to come out. And what the Secure Act is saying is it's all going to have to be paid out from the inherited IRA to the trust in 10 years. And now with the new regulations we know there's going to be annual RMDs in some cases that need to be paid out from the inherited IRA to the trust. And with the traditional IRA, all those distributions from the inherited IRA to the trust, they are all going to be taxable. And if the funds are held in the trust rather than being paid out to the beneficiary, which is very common because with a trust, you often want to protect the beneficiary, sometimes from themselves. So you want to hold the money back. So you'd be looking at high trust tax rates then hitting when those distributions come from the traditional IRA to the trust.
Yeah, and sometimes it's just those trust distributions are forgotten too, right? So trustees are often named as, brother, cousin, uncle, aunt, friend, whomever. And they may not be a professional in this, and most aren't. And they could just miss those distributions. Money sits in there, and then then you've got a tax bill, right? A higher than tax bill than it should be. So really great question for some fodder here, Walter. Appreciate it. All right. And then Larry asked, what is an UTMA? We talked about UGMA, and Larry is asking, what's an UTMA? UTMA.
Yeah, they're very similar. The idea is the same. Some people have some states have UGMAs and other states have UTMAs. Just very just different versions of essentially the same concept. Where you have an account set up for the benefit of a minor with a custodian, and then when the minor reaches the age of majority under state law, they have access to the funds. So it really, for our purposes here, they're the same. It just depends what state you happen to live in.
I don't even remember what Pennsylvania is. I think Pennsylvania might be an UTMA state, but I think it's Uniform Transfer to Minor Act. Is that what it is?
Yes. Yeah. Uniform gift to minor, uniform transfer to minor, but it ends up being all the same for our purposes here. And yeah, I'm not sure about PA either.
I can't remember. Yeah. But thanks, Larry. That's a great question too. Okay. Keith has a question. I know this is important to Keith. I think we've talked about this before, and I think he's checking my answer, but does a Roth IRA go into a special needs trust tax-free as life insurance would?
Yeah. Both a Roth IRA and life insurance are great ways to fund a special needs trust. I might give a slight edge to life insurance because you don't have any of the complicated IRA distribution rules that apply to inherited IRAs. You don't have to worry about that with life insurance. But both life insurance and a Roth IRA could fund a special needs trust tax-free. And it's really important with a special needs trust because these trusts are designed to protect the beneficiaries' government benefits. If their income is too high, they lose all kinds of government benefits. So what you can do is set up the special needs trust, and then the life insurance or the Roth IRA can go into the special needs trust and be held back. So it wouldn't be paid to the beneficiary, be held in the trust. So that's why trust tax rates would be such an issue. And with either life insurance or a Roth IRA, you avoid the problem altogether because both life insurance and Roth IRA distributions are tax free. So yeah, that's a great question. If you're planning for a special needs beneficiary, if you're thinking about a special needs trust, Roth IRA or life insurance are definitely preferable to a traditional IRA.
Yeah, for sure. And you have to consider with life insurance, you do get some added benefits early on, certainly. And that is, you get a higher death benefit for the amount of money that you're putting in. Now, it can be argued over time, what's the payoff from an investment point of view? But you get, that leverage of an increased value immediately. So if you are looking to fund a special needs trust, it can work very, very well. Some of my two favorite things, Roth IRAs and life insurance, right? Sarah, this has been great. Anything else? We don't have any more questions. Anything else that you want to wrap up with?
I think we've really hit on the important concepts. I just would like to reiterate that with the Secure Act and with the Secure Act regs, if you are thinking about naming a trust as your IRA beneficiary, it's great to consider going the Roth conversion route. It's good. Conversion isn't for everyone, right. But if you are thinking about naming your trust as your IRA beneficiary, and the trust is going to be a discretionary trust, and funds are going to be held back, you are a good candidate for a Roth conversion.
Yeah, it's certainly different for everybody, and you really got to work the math and make sure that it's going to be beneficial to you. I've heard all kinds of crazy things about Roth conversions. People doing a bunch of money at once when that's probably not necessary, and converting too little, converting way too much. So it really is important to work with somebody who understands this, who does it every day. This isn't something you want to dabble in. Sarah and I were talking before the webinar here about attorneys. She said, just because an attorney says it's a good idea doesn't mean that you should do it. And attorneys make mistakes, and accountants make mistakes, and not everybody works on these things all the time. I once had an attorney, I might have told you, Sarah, that called me one day. This goes back some time ago, before the stretch IRA was eliminated. And they said, I want you to help me handle an estate. It's all IRA money, but it's okay. I already talked to the person in Vanguard, and we've opened up an estate account and transferred the $2 million into the estate account. Yikes. That was the face I made. I thought, oh no. So these things happen. So you really got to focus on the people that spend the time, the resources, and the commitment to answer these complex questions. These were really great questions you folks had, and they weren't easy. And most people can't answer them. That's why I rely on
this is tricky stuff.
Yeah, it's really, really tricky stuff. So I want to thank everybody for joining us. We will have of course, our Tuesday live webinars on Tuesday again this week, and we go over. I was sharing with Sarah that I spend the first 10 or 15 minutes, and we go over the slot mailbag, which is when people write in questions, and Sarah and her colleague.
It's like Dear Abby for IRAs, right?
It's Dear Abby for IRAs, and I'll tell you something about the Financial Planning Association too in a moment. But and then we go over some market discussions, and I talk about some analyst reports, and then I do a financial planning topic. So I kind of break it down in 15-minute intervals, and we usually stay around 45 minutes, but I know I can talk a little bit, so sometimes it goes an hour. But so I ask, join us for the Tuesday webinars, and there's no cost for these. Somebody said something, my son actually said, you should tell people that there's no cost, because it might seem like there's a cost. I don't charge for this. Now that might change in the future. We're planning on doing a member only or client only portion of the website, because I have over 100 of these webinars now that are on YouTube or on the website, and it's a lot of material. But join us, and then April 27th, you all be getting an invitation. David McKnight is joining us live here in Newtown. That's going to be a lot of fun at the old Newtown Theater, which is the longest running theater in the United States. It's a really, really old, neat structure that's just been completely renovated. And if you've never heard David McKnight speak, he's fantastic. He's a great author. Sarah and I were talking about his book, Power Zero, before the webinar. Ed wrote wrote the intro of that book as well. And one day we'll have Sarah here to join us live too. You do that, right, Sarah? You come out?
Yeah, that would be great. It's great to get back to in person. We like virtual, but we like in person too.
Yeah. So it looks like we have maybe one more comment or question. Let's see. Roseanne says, such an interesting, informative webinar. Thank you both. That's very nice.
Oh, thank you.
I'm glad Roseanne said that, because you folks are all going to receive that email after this. And I think it comes out the next day or maybe even later tonight. That says, thank you for attending the webinar. I've attached a survey to that email. If you don't mind, just take a moment. I think it's 7 questions. Just go through and give me your thoughts about this webinar, other webinars, just so we can make these the best we can for you. Sarah, it was great seeing you.
Oh, good to see you, Mark. Thank you so much for having me.
Sure. Can't wait to do it again. All right, everybody. Have a great night, and take care. Bye-bye.
Good night, everybody.